Welcome back to the show. Employers added a seasonally adjusted 287,000 jobs in June for the strongest job growth in 8 months. Nearly every sector of the economy added jobs, a far contrast from May's catastrophic numbers. To get his take on that, Peter Schiff is on the show. He's the CEO of Euro-Pacific Capital. I first asked him if the June jobs report actually indicates May's jobs report was an aberration. Here's what he had to say.
Well, to me, probably June is more the aberration because May was more consistent with April. Both of those months were extremely weak. And I'm very suspicious of the June number. We'll see how we revise that next month. You know, we revised down the May number when we got this number. But again, even if most of the jobs end up holding, I still don't think it validates any kind of legitimate recovery because a large percentage of those jobs are simply conjured out of thin air during using the birth-death model, where the government simply assumes that jobs were created by businesses that they believe started up. But also, if you look at the demographics, all these jobs went to people 55 and older. Younger workers, 24 and under, net lost a tremendous number of jobs in June. And of course, the jobs that we did create were very low-paying, service sector jobs, part-time jobs. We continue to hemorrhage full-time jobs, higher-paying jobs, the kind of jobs that can support a family, and instead we replace them with these low-paying part-time service sector jobs. So it is not a good sign for the U.S. economy.
So you're still concerned about the types of jobs that are being added. And you can certainly argue that the pace of job creation has slowed since the winter. I think we've seen a trajectory downward since about February. But is it the kind of pace that really signals a possible recession? Morgan Stanley's chief economist, Ellen Zentner, told the Wall Street Journal that, to the contrary, this actually looks more like a graceful slowing into a lower channel of job growth, and that this is normal at this late stage of the business expansion. I mean, does she have a point there?
No, I don't think so. And unemployment is not a leading indicator. It's more of a lagging indicator. It's when employers are surprised by a downturn in the economy that they adjust their payroll. So the fact that so many employers don't perceive just how bad the economy is going to be doesn't invalidate the fact that either we're already in a recession or a recession is going to be starting very quickly. And once employers figure this out, then they're going to be trimming their payrolls, I think, rather substantially. And so as the recession progresses, that's when you're going to start to see big layoffs. In fact, normally layoffs continue even after the recession is over. But this recession is going to last for a long time. I think it's going to be longer lasting and deeper than the recession that we had in 08 and 09, which we call the Great Recession. So again, I'm not really sure what we'll call this one, the Greater Recession, but it's going to be worse.
Well, what about wage gains? I mean, that's been a point of concern over the past year. We want to see those wages go up. But in recent months, we have seen them start to move upwards. And in fact, in June, average hourly wages rose 2 cents an hour to $25.61. And many would argue that indicates employers are finally beginning to compete against each other to attract candidates, that the labor market is tightening. I mean, what's your take on why wages have gone up?
Well, first of all, they're not going up very much. That was still below estimates. And prices are also rising. So we do have inflation coming back. And so wages are rising as well as prices. But real wages are still not, in fact, going up. But you do have some mandated minimum wage hikes that have been taking place throughout the country. And since so many Americans now have minimum wage jobs, those mandatory increases are going to filter through into these numbers. But as employers react to the higher minimum wage by laying workers off, this is going to begin to bite. In fact, I'm sure that's one of the reasons that you're seeing massive layoffs for workers 24 and younger, because these are the workers that are most impacted by a hike in the minimum wage because they have the least amount of skills, and therefore they're the people that are going to be laid off first as a result of increases in the minimum wage. And of course, it's going to be increasingly more difficult for younger Americans to get their first job because the government is pricing those jobs out of existence.
And Peter, in the last Fed minutes, we learned that there were two things the Fed was really waiting on to make their determination to raise rates: the outcome of the Brexit vote and the jobs data. We now have both. So given the full picture, I mean, what kind of assessment do you think we will get out of the Fed at the end of this month?
Well, I don't think the Fed's going anywhere. Again, as I've said since the beginning, since the first time the Fed raised rates in December, I believe their next move is to cut rates. And they weren't really waiting on anything. Those are just the excuses. The Federal Reserve can't admit that the economy is too weak for an additional rate hike. So they have to keep pretending that they're contemplating actually raising rates. And so they have to make up some excuses as to why they're not doing it right now and while they're waiting for some other data to come in. But it really doesn't matter what the data is, because it's never going to justify a hike. They're always going to come up with an excuse why they're waiting. Meantime, the next thing they're going to do, I think, is go back to zero. In fact, they may not stop at zero. They may go negative, and I do think they're going to restart quantitative easing, because I think we've got a much bigger bubble on our hands than the one that popped in 2008. And I think the Federal Reserve finally recognizes this, and they know that this bubble is too big to pop, and they are determined to blow air into it indefinitely.
So you think that at this point the Fed is looking for more reasons not to hike rates rather than to hike them?
Oh, absolutely. I mean, they tried to hike rates in December, and it was a complete disaster. And so they don't want to do that again.
Well, the question is, I mean, how does the Fed handle inflation at this point? We know they've said time and time again that they're looking for that target rate of 2%. So how do they back themselves out of that corner? Because we know the Fed has to be concerned about protecting its credibility, right?
Well, they have no credibility, and they can't handle inflation. You know, it's the opposite of Teddy Roosevelt. When it comes to inflation, they speak loudly, but they have no stick at all. And because they have no stick, that's why they have to talk so tough. They continue to pretend that if inflation ever were to rear its ugly head, that they have the tools to rein it in. But no, they don't, because we have so much debt in the United States, particularly the government and the Fed itself, and the debt is so short-term in nature on the federal level that any meaningful increase in interest rates would bankrupt the country, would collapse all the big banks that were bailed out. They would all fail. The U.S. government would have to default on its Treasury debt. So the Fed can't raise rates, but it can't admit that. So it pretends that if inflation, picked up, that they would do something about it, but they will do nothing about it. It doesn't matter how high inflation goes, 2.5%, 3%, 4%, 5%, doesn't matter. The Fed will stay at zero or practically at zero. They will never try to rein it in, because if they ever tried, they would cause a worse financial crisis than 2008.
Hello.
All right, we're here. We're on air right now. I'm sitting here with Ed Harrison. We're talking about European banks. As I mentioned, the FTSE 100 is up some 20% since February lows, despite the uncertainty surrounding the country's recent decision to exit the EU. But not every sector is winning in that equation. In fact, one of the sectors seeing a lot of pain is that of financial services. And that's reflected across the board, actually, in Europe, where banks are facing huge losses. That's exactly what we're going to talk about right now. Ed, I've seen some pretty scary charts from Deutsche Bank regarding stock prices and credit default swaps. Is this whole Euro bank crisis a real thing?
I think the answer is probably maybe is the best that you could say. That my mantra is to prepare for the worst, but expect something much better than that. Usually I say prepare for the worst, expect the best.
Right.
But in this case, I don't think that you can expect the best. I think that what they're pricing in with Deutsche Bank, both CDS and the share price, is the optionality value. That is that shares are a residual claim on profits, and CDS is really an option value to, if this company goes bankrupt, then we get made whole. So in both cases, you're talking about option values, and what's happened is that the bad scenarios have become much more prevalent in terms of people's thinking.
Tell us a little bit more about the CDS. Why is it so significant, and what is Deutsche's CDS saying right now?
Yeah, so I think that it's not really saying that Deutsche Bank is bankrupt or it's going to go bankrupt, but when the credit default swaps rise, what it means is there are more people who are concerned that what used to be considered tail risks, things that were likely to not happen, are now going to happen. So when you see it going up, what it says is that bad scenarios have become much more prevalent in terms of the probability of outcomes, and people are afraid of that. Now, you can get these huge spikes up, and then they come straight back down, which shows that really it's just a panic. But what we've seen in the CDS chart for Deutsche Bank is that they've been going up steadily, that behind the scenes, that completely unrelated to Brexit, what we're seeing is that people are upset about where Deutsche Bank is headed, and a lot of it has to do with residual litigation claims against Deutsche Bank, their huge derivatives portfolio book, and their exposure to other banks like the Italian banks.
Yeah, I was going to ask you, I mean, what about Italy? Because that is what everybody is talking about right now. Isn't that the real problem area?
Yeah, so that is the real problem area. The Italian banks, basically, I mean, if you look at the Italian banks, there was a report in Wall Street Journal last week. It said that bad loans as a percentage of loans in Italy are 17% of the total. Now, at its worst in 2008, it was 5% in the United States. And right now, that number is 17%, so almost 10 times the number of bad loans in the United States. So there's no way, if all those loans actually went bad, that any of those banks are solvent. So you have solvency concerns about those banks, and then the question becomes, how do you recapitalize them?
Right. And to what extent can we blame Brexit? As you mentioned, I mean, we can't really put all that much blame on Brexit because we know this has been happening for a very, very long time, and we've seen the markets sort of come back. So it seems like they're even minimizing the tail risk of Brexit. What are your thoughts on that? So,
you know, the markets are totally separate. They're looking at the upside versus with the Italian banks, they're still in the doldrums. And I think that really what's going on with the Italian banks is that when Brexit happened, what was a problem that had been festering already became a bigger problem because there was no ability to go to the private markets and actually recapitalize these banks. So the whole construct in Europe now is that before public money gets used to deal with any problems whatsoever, private money has to be used. That means you have to recapitalize these banks and then bail in investors, that is, debt holders and potentially deposit holders. And so, you know, these banks had been slipping in terms of their share value. And when Brexit happened, they slipped so much that people now realize that the only way out was bail-ins. There was going to be no private money coming into these banks, and that's the exact same thing that we saw with Deutsche. That's why Deutsche is in trouble as well. So now we have to deal with is the bail-in mechanism that the EU is so keen on actually going to happen. So it may have exacerbated some underlying issues. What's your perspective on why the whole Italian banking system is under fire right now? I think that it's under fire because of the real economy. Basically, you have an interaction between the real economy and the capital. That is, that ever since the euro started, the Italian economy has been growing so incredibly weakly that as a result, bad loans have been piling up. And when you have a capital base which is very minimal and these banks can't be recapitalized, they're not going to have any loan growth. And so the two sort of feed upon each other, and they lead to a problem where bad growth in loans leads to bad growth in the economy and vice versa. So what's your sense on a crisis? Crisis, no crisis? What are your thoughts? My feeling is that if I had to call it, I would say no crisis. I think that this will pass, but the problem is still there, and it's not going to lead to a crisis yet. Maybe down the line. Maybe down the line. All right.